Hi everyone, it's Matt Carter from myhomeloan.co.nz with the latest update to fix or float in 2012 for New Zealand. So it's a very popular question that a lot of people ask when it comes to your mortgage, whether to fix or float, and often it changes and depends on what the banks are doing. So I want to talk a little bit about this in today's update video. Again, if you want more free home loan and mortgage advice, head over to myhomeloan.co.nz. So one of the most difficult decisions we all have in regards to our mortgage is whether to keep the interest rates variable or to fix the rate. With interest rates so low, this can be a call from some banks to look at fixing mortgage rates. Unfortunately, to confuse the situation, a number of other banks say they don't bother. For example, Westpac has been encouraging their clients to change to a fixed rate, while ANZ says that it's too early to make a change and people should wait a little bit longer. So presently, official cash rates set by the Reserve Bank is at 2.5%. And this is a historic low, and the Reserve Bank is not expected to lower the rate any further, regardless of what happens with the world economy. But we'll have to wait and see what happens. So the official cash rate is used by banks to set their interest rates. Given the rate is not going to go any lower, many people may ask themselves, why not fix now and lock down this low rate? And it's a fair enough question to ask. See, at present, and this is as of recording this particular video on this is March 2012, the lowest fixed rate is around about 5.79%. So a mortgage of 200 grand, this means that your monthly payment would be 1,408, but the floating rate is presently only set at 5.65%. So it'll give you a monthly payment of 1,392, slightly lower. But keeping your mortgage on a variable rate, you'll be paying $16 less a month. So although this might not seem like a large amount, it does add up. And $16 in your pocket rather than in the banks, which I'm sure we'd all rather have. Now, if you want help in calculating exactly what your real payments will be, if you head over to myhomeloan.co.nz, we've got under the calculators section, we've got a whole lot of mortgage repayment calculators that you can use, which will help you work out what your monthly payments will be by adjusting the interest rate. So head over there and check out the tools that we put on offer for our visitors. So, what is the Reserve Bank doing? So your decision to change your mortgage rate can depend on whether or not the interest rate set by the Reserve Bank is going to be increased. That's pretty obvious. At this point, there is not a lot of evidence that the Reserve Bank plans on increasing interest rates. In fact, New Zealand Institute of Economic Research does not see any increasing being made to the official cash rate before the mid-2013. The view that the weakness of the New Zealand economy, as well as problems with world economy, will work to keep interest rates low. There is also debate over whether or not gross domestic product, or GDP, will increase, and if it does, will that result in an increase of an interest rate? And some economists claim that the rebuild of Christchurch after the earthquakes will stimulate GDP and result in an increase of interest rates. However, the Reserve Bank has the belief that while the GDP may rise as a result of the rebuild of Christchurch, this will not result in any inflation. There will be no need to raise the official cash rate, therefore. Other economists believe that the rebuild will not have as much of an effect on GDP in the future, and it will be at least a year before any effect of the rebuild is noticed. So there is varying opinions. So essentially, the choice to change to a fixed rate of interest or leave your mortgage on a floating rate if that's what you're on will depend on your point of view concerning the growth of GDP and its effect on inflation. So if you think there will be growth without a rise in inflation, or the rebuild of Christchurch will have limited to no impact on GDP, then you may be more inclined not to worry about changing the terms of your mortgage. See, right now, there is very little difference between fixing and floating rates of interest. So many people are not concerned about making the change. It doesn't save them a lot of money, but it will cost them bank fees and the time to make the changes on their interest rate. Because you have to realize that most banks will charge you a fee to change terms of your mortgage. So you need to take that into consideration. However, like I said, if you believe that Christchurch rebuild will fuel a growth in the GDP and will increase in inflationary pressure, then you may well give serious consideration to switching to a fixed mortgage. See, from this point of view, Fixed mortgage rates will begin to rise when inflation rises. So you want to be able to get in now and fix in the low rate. The concern with waiting is that if fixed rates for mortgages begin to rise, many people will most likely rush in to lock in a fixed mortgage rate. And this rush itself will cause rates to rise. And depending whether you rush in, you may end up paying a higher interest rate than you would have if you got in before the rush. Makes sense. Now, given the conflicting information and varying opinions, it can be difficult to decide on what to do regarding switching to a variable or sticking with a fixed interest rate. And since it's early in the year, you may want to hold off changing your mortgage to a fixed rate and revisit the issue later in the year. That's completely over to you. You'll need to keep an eye on the news reports about the rebuild and its effect on GDP, as well as any concerns the Reserve Bank is about to increase the official cash rate. And you'll see this happening, then look to switching your mortgage. So that's the end of this quick update from my home loan team on whether to fix or float in 2012. For more information, free tools and mortgage advice, if you want to talk to a mortgage broker, head over to myhomeloan.co.nz and we'll help you out. Have a great day.